You're listening to Market Champions, a podcast on navigating the financial markets. Here's your host, Srivatsan Prakash.
This episode of Market Champions is brought to you by Simplify ETFs. For more information, visit simplify.us. No simplified funds will be discussed during this podcast. Hey guys, welcome back to another episode of Market Champions. I just wanted to remind you to like, subscribe, and leave a comment. Really helps the page grow, really helps the podcast grow. Thank you so much for your support. And now on to the interview.
Hey everyone, welcome back to another episode of Market Champions. Today it is my pleasure to welcome Eric Basmajian. Eric is the founder of EPB Research. Eric, thank you so much for being on the podcast. It's fantastic to talk to you.
Yes, thanks, Trey. I'm really excited to talk to you.
Awesome. Eric, let's get started by talking a bit about your background, how you, sort of found yourself within finance, and I guess more specifically sort of macro research. You sort of started off in wealth management, and then you sort of found your way to EPB Research. So can you talk a little bit about that, how you got into finance and sort of your journey within the finance industry?
Mm-hmm. Yeah, so I've always been interested in finance and economics, and I studied economics at NYU, New York University. And while I was there, I took a course in the history of financial crises, basically going back and studying all the financial crises throughout the last couple hundred years. And that was a course that really had a big impact on me. It fascinated me how these crises came throughout periods of history. And the common theme was that they all were missed by majority of people. And it was intriguing to me why these big financial events were missed by the masses, and sort of got me studying, what were the commonalities between these periods of financial excess, mainly related to excesses and buildups in debt. So that really sort of solidified my passion for economics and studying economic history. I spent a little bit of time in wealth management as I was graduating. Then I went to work at a quantitative hedge fund in Midtown Manhattan. And I sort of took that economics background with some of the data analysis and statistical tools that I was working with at the hedge fund, and sort of to create my own research process, combining these longer term secular trends that play into these larger financial crises and debt buildups over time, as well as the business cycle analysis and the shorter term growth rate cycles and the ebbs and flows that we feel in the economy every couple of years. And I started publishing that research in various places, and it was relatively unique in the marketplace, got a relatively big traction pretty quickly. And the rest was history. I started to publish under EPB Research, and here we are almost 6 years later, and still writing on business cycles and hopefully what to expect over the coming couple of quarters.
Awesome. And yeah, so that's sort of a great note to start on. Starting as I think the first thing that I wanted to jump into is this idea of where we are in the business cycle. And so you're sort of I think especially on LinkedIn, you sort of classify yourself as an economic cycle analyst, and so I think you're probably the right person to talk to at this juncture.
I hope so.
Yep. So, one thing that's been on everyone's minds lately is sort of this idea that we're going to see a recession within the next, say, somewhere around 12 to 18 months. So, that's it's sort of become, and I think, Kevin Muir, the macro tourist, put out a note about this not too long back, where he talked about how this might be the most anticipated recession ever. So, Juan, what's sort of your take on that? And, just broadly, what's sort of your take on even on this idea that we're going to see a recession sometime soon?
Yeah. So I study business cycles, and the first thing to know is that we need to have criteria on how we define these cycles, right? Because everyone may be talking about different things. Are we talking about 2 negative quarters of GDP? Are we talking about job losses? Like, how do we define this cycle that we're talking about? And the way that I define the business cycle is based on what are called coincident economic indicators. They're called coincident indicators because they coincide with the peaks and troughs of the business cycle, right? So the data that falls into that coincident indicator bucket are your big, broad, reliable measures of income, employment, consumption, production. You have your things like GDP, GDI, and there are other, individual indicators that we can talk about, but basically anything that is a reliable measure of, household incomes, employment, aggregate consumption, and, the production that occurs in the economy is what defines the business cycle. That defines whether we're in recession, we're in an expansion, the economy is accelerating, decelerating. And what I do is I take a composite of these indicators from all segments of the economy. I mash them into one index, and I track the growth rate, and that gives me a totally objective reading of where we are. And that index currently is trending at about 1.8% over the last 6 months. Now, the long-term average, like over the last 10 years or so, is about 2%. So the growth rate in the economy is decelerating from those crazy artificial stimulus-induced peaks that we saw in 2021. We had growth rates of 8, 9, 10%. So the growth rate has been decelerating. We've fallen to about 1.8%, which is slightly below, quote unquote trend, but it's not below zero. So that's not a recession yet. So where are we? We're decelerating. We're getting closer and closer towards a recession, but we're not quite there yet. So what are the things that are holding us out of a recession? Well, employment is still growing at about 2.5%. So that's still a little bit too strong for a recession, although we can maybe get into some of the nuances with the household survey and the establishment survey. But broadly, employment is still a little bit too strong. Industrial production is weakening rapidly, but it's still trending at about 2%, a little bit too strong. And on the other side, we have real incomes, which are negative. So that would be, consistent with recessionary periods. So we have employment that's a little bit too strong and production that's a little bit too strong. So the economy is not quite in a recession yet, although we've slowed dramatically and we're now growing below trend. So the real question now is, where is that coincident, growth heading? Are we going to go from 1.8 to 1 to 0, ultimately, into recession? Or have we sort of seen the bulk of the slowdown already? Are we going to start to bottom out and move higher? And what I use to determine that is I study, what are called leading economic indicators. So the coincident indicators coincide with the peaks and troughs of the business cycle. The leading indicators are the indicators that move before the economy moves into a recession, for example. And, we can maybe unpack some of this, but leading indicators currently are severely negative in my analysis, implying that a recession is certainly on the horizon. And where I am slightly different than consensus is I don't believe a recession is sometime in the next 12 to 18 months. I think it's more likely within the next 6 months.
Got it. And so, when it comes to these leading indicators that you watch, so can you give some examples of, of what you touch upon, of what you watch, so that we could touch upon them? And, one thing that I've seen you highlight has been housing and sort of this mismatch between the supply and demand characteristics of housing. So if you look at construction, demand versus supply, you sort of see a massive divergence there. So, is housing one of the things that you track? Because, I think housing has this very strong multiplier on the rest of the economy.
Yeah, very well said. So when I study leading indicators, I classify them into 2 buckets: what I call longer leading indicators, things that have like a really advanced lead time, and then shorter leading indicators, things that would say, hey, you got to be alert to something that's about to happen in the next 3 or 4 months, let's say. And the reason that I separate them, and I believe that it's good practice to separate them, is because the longer leading indicators, while extremely informative, are sometimes so long that they're not really relevant for maybe asset allocation decisions or something like this. So the housing sector, for example, is one of the most reliable leading indicators but it's in that longer leading indicator bucket. So you see the housing market generally turn down sometimes a year, year and a half, sometimes 2 years before a recession starts. Now, that doesn't mean that you should ignore it. It's an extremely relevant sector of the economy. It's extremely important because, as you correctly said, it's a very high multiplier sector. But you can also witness the housing market slow for 6 or 8 quarters, and that could be quite early when you're trying to maybe construct an asset allocation. So when I look at leading economic indicators, I'm looking mainly at the rate of change in monetary policy. So when monetary policy, let's take the current environment that we're in, starts to move in a tightening direction, that presumably puts upward pressure on interest rates and mortgage rates, which then slows the housing sector. So that interplay between monetary policy, interest rates, and the housing sector are a good barometer of the longer leading bucket. Then once you get a downturn in those longer leading indicators, which we've fully seen already for several quarters now, there's not really a whole lot to do yet in terms of maybe asset allocation. But what you do want to do is you want to look at, okay, we have a downturn in some of these really early sectors. I need to be on high alert for that next part of the sequence to fall apart. Those are your shorter leading indicators, and that's where you'd see the slowdown spread through the manufacturing sector, right? Specifically your new orders. So if you start to see new orders come down, you also may start to see an imbalance between inventory and sales, right? So you may hear retailers start to note that they have bloating inventories. You may start to hear about downturns in the transportation sector, because if you have a slowdown in the housing sector, and the housing sector is responsible for a significant volume of goods moving throughout the economy. You think about washing machines and dryers and microwaves and all these furniture, all these appliances that need to be shipped around the world from China and other countries to the United States, put on trucks, moved to the actual home. Then you're likely to see downturns spread throughout that transportation manufacturing sector. You also may see some of the early warning signs of weakness in the labor market through initial jobless claims, hours worked, some of those types of things. So where we stand today is, as I mentioned, those coincident indicators are certainly slowing down pretty dramatically. We're at about 1.5%, 1.8%. The longer leading stuff, so monetary policy, interest rates, and housing, are certainly consistent with recessionary periods. And then we're just starting now, October, November, early December, starting to hear about recessionary conditions in manufacturing, transportation, trucking, things like that. So that is my warning sign that, we may see recessionary conditions proliferate through the coincident indicators sometime in the next 3, 4, 5, 6 months, something in that range.
So just to sort of sum up what you said, so when it comes to so you sort of split leading indicators into sort of long leading indicators and shorter leading indicators. And so within that long one, so I'm guessing your favorite is sort of housing, and then you have monetary policy, but sort of function as a shorter leading indicator. Did I sort of summarize that correctly?
Yeah, so I put monetary policy in that longer leading bucket as well. So I'm looking at the interplay between how is monetary policy impacting the housing sector, for example, and then how is the housing sector impacting the manufacturing sector and the transportation sector, and some of those, maybe some of your durable goods consumption, and then we get to your coincident employment and things like that.
Got it. And any other leading indicators that you wanted to mention that we sort of missed?
Yeah, so I'll give you sort of two conflicting ones. So we have the new orders index. Let's say from you can take sort of any reading of new orders that you want. You don't have to use one specifically, but one that most people are familiar with is the ISM, Manufacturing New Orders Index.
Yep.
That has been below 50, if my numbers are correct, for I believe 4 of the last 5 months. So that is signaling that new orders are contractionary and persistently so. That would be relatively consistent with the onset of a recession, because when the recession began in 2007, December of 2007, ISM new orders was about 47, and it's about 47 today. So that level, below 50, staying below 50 for a couple of months is relatively consistent with the onset of a recession in the relatively near term, particularly when it's preceded by a big downturn in housing and your earlier stuff. On the flip side, though, we have to remain consistent, and we have to look at the whole basket of shorter leading indicators, of which one of them would be your initial jobless claims, for example. And we haven't really seen material upticks in initial jobless claims quite yet. So that would be one that may suggest that a recession is perhaps a little bit further off. But I think there are some significant nuances to the employment situation now that may be clouding that indicator a little bit.
Got it. Awesome. And so, let's sort of start jumping into housing. So, when it comes to housing, so I think the one thing that we see in almost all data points when it comes to housing has been that housing has sort of been down the toilet over the last, say, 12-ish months. And as you mentioned, housing has a long lead when compared to the economy of about 12 to 24 months. So, when it comes to thinking about this, so, what are sort of the knock-on effects of this sort of downturn in housing, and when it comes to sort of an investment or asset allocation standpoint, what should asset allocators and investors be looking at, especially when it comes to playing this sort of thing?
Yep. So the housing sector, the first thing that we have to sort of lay out is when we're talking about the housing sector as it pertains to a leading indicator, we're not talking about the price of homes. We're talking about the volume of transactions. And that's really important, because in the housing sector, there is a volume cycle and then there's a price cycle. And the price cycle significantly lags the volume cycle. It's sort of the same concept of how inflation lags growth. Price lags volume. So we want to stay focused on the volume of activity or the volume of transactions in the housing market, because that's what has the multiplier effect through the manufacturing sector and the transportation sector. So as you noted, we've seen very, very, very significant declines in the volume of activity in the housing market. And we're actually starting to, the declines have been so severe, it's actually starting to lead to price declines in a pretty dramatic way throughout most parts of the country. How you would play that from an asset allocation perspective, or how you may start to think about that, is, at least in the way that I do it, is when you see that downturn in the housing market and it's coupled with, let's say, a contraction in monetary aggregates, right? So let's say the Federal Reserve is raising interest rates and contracting monetary policy. So you see, shorter term interest rates rise. You see your monetary aggregates start to contract. You see the yield curve invert, and then you see the housing sector slow down. That constellation of variables all happening at the same time is very, very solid evidence that monetary restraint is deeply entrenched in the economic system now. So then you say, okay, monetary policy is starting to bite very clearly. It's being reflected in a contraction in monetary aggregates. The yield curve has inverted, which is a signal of tightening, tightening money. And then the volumes in the housing market have slowed down. So monetary policy is entrenched. Now, what's important about that is, with a relatively high degree of certainty that slowdown that's sort of baked in the cake is going to have to flow through the rest of the economy, irrespective of what the Federal Reserve does next. And that's sort of where we are today, where I think a lot of people may be overly reliant on a soft landing, where they're sort of just looking at the coincident indicators and they're saying, we're not in a recession yet. So if the Fed pivots now or soon, we may be able to avoid a recession, when that's really unlikely to be the case, because the downturn is so deep in that longer leading bucket that you have a really high degree of confidence that even if the Fed pivots today, that is going to still have to spread through the rest of the economic sequence and ultimately to coincident indicators. So to me, the way that to use the housing sector and those longer leading indicators is really just to sort of give you a warning signal and to put you on high alert for what's to come. And then once you see that slowdown leak into those shorter leading indicators like your new orders, your transportation, your trucking, that gives you a really quick sign to say, oh, okay, this is definitely going to hit coincident indicators in the next couple of months. This is not noise. This is not random. This is part of a larger monetary and sort of business cycle process that's unfolding. So it gives you your first warning to pay attention. Then when you see confirmation, you're ready to make an asset allocation decision, while most people may still be chalking up, oh, that was, what did we hear, right? We heard, oh, the slowdown is just the housing sector, right? And then the Chicago PMI prints 37, trucking sector starts to slow down, and the ISM goes below 50 and say, well, maybe it's just a soft patch, right? You really have confidence that, no, this is a cyclical process that's underway, and it's undoubtedly going to hit those later indicators in the economy.
Absolutely. And I think, one of the interesting things about housing is sort of the point that we made earlier, where housing has this large multiplier on the rest of the economy. So in a way, housing has its impact on so many different sectors within the economy. So one thing that I wanted to bring up was this idea of looking at transportation, container rates, trucking rates, etc. And so could you talk a bit about the history of shipping and trucking rates as sort of a leading or a coincident or a lagging indicator?
Yep. So when I think about the trucking transportation sector, I'm thinking about it the same way that I think about housing, which is there's a volume cycle and a price cycle. So let's talk about the volume cycle first. The volume cycle is where we would see the demand for trucking capacity go down. We would see maybe some signs of reduced hours worked in some of the trucking sectors. And that is very consistent with a slowdown in economic growth. Once that slowdown in economic growth persists for long enough, companies try and hold on to that pricing power for as long as they can. And then when we start to see them, cut their prices, so reduce their, container rates, their trucking rates, all of these types of things, that's actually a sign that the slowdown has been deeply entrenched, and it's actually going to start to hit inflation, which lags the business cycle. So while economic growth has this sequence of longer leading indicators, shorter leading indicators, and coincident indicators, inflation has its own sequence, which I define as a money price wage spiral. Now, a lot of people get that mixed up because they talk about inflation as a wage price spiral. That's not really how it works. It's a money price wage spiral. So using container rates as an example, what do I mean by that? Well, first, we had a very significant contraction in monetary policy or money, monetary aggregates, right? So Federal Reserve tightens monetary policy. They initiate quantitative tightening. You see interest rates going up. Just the monetary growth in the economy starts to contract. Then, so it's money, price, wages. Then prices throughout the economy start to fall. You see asset prices falling, home prices falling, container prices falling, trucking prices falling, commodity prices falling. Prices empirically throughout the economy start to come down. But wages, employment, core inflation, core services, these types of things remain elevated. If that money price wage spiral is sustained, you continue to contract monetary aggregates, the prices will continue to come down, and then ultimately employment and wages will fall. So the fact that we're seeing huge declines in container rates and all of these types of things is evidence to me that that money price wage spiral is underway, and it's going to have a significant reduction on employment and wages in the near future.
Got it. And so, within that framework, typically I have seen people bring up the argument that wages, both generally as well as specifically, tend to be sticky, and so it's sort of very difficult to bring wages down. And sort of the argument is that, you know, what we're seeing right now, just broadly within the economy, is we are seeing some sort of a wage price spiral where labor, where sort of the bargaining power of labor versus capital has gone up a lot post pandemic, especially with the stimulus checks, etc. And so therefore, one, wage growth is at least to some extent sticky, and at least what is going to remain is sort of this high bargaining power of labor. So I guess this is slightly off the topic, but you know, could you comment on that? You know, what's sort of your view? What's sort of your view on the wage growth and the labor and labor market dynamics that we've observed over, say, the last 12 to 18 months?
Yeah. So in terms of wages, you know, I don't think that the bargaining power for employees and wages is as strong as the as sort of the mainstream narrative. And the reason for that is because while wages are going up and they're going up at a level that we haven't seen in quite a long time, they're still growing below the rate of inflation, right? So the inflation rate was 7, 8, 9%. And if you look at something maybe like the Atlanta Fed wage tracker, right, we're looking at levels of 5, 6, 7, right? So employees are getting wage increases, but it's really the bare minimum that they're able to get because they're still losing ground to inflation.
Right, real wage growth is negative.
Exactly. I have a chart on my Twitter feed where I look at real private sector income. So income derived from every component of the private sector, basically just excluding what comes from the government. And if you take the trend line that the economy was on, real incomes were going up at about a 2.8% annual rate. And if you take that trend line over the last expansion and extrapolate it to where we should be now, real incomes for the private sector are $1 trillion below that trend line. It's a very, very, very significant gap that's developed. Now, the government, you know, has plugged some of that gap with increased transfer payments, but they've had to borrow more money in order to do that. So you're just basically borrowing money to pay people, which is ultimately an unsustainable path. But the fact that real incomes have deteriorated at such an extreme level, to me, is a sign that the labor strength is not as strong as people suggest, because even in the 1970s, during the period of high inflation, real growth, or after inflation growth, was actually still quite strong. It was one of the stronger decades in terms of real wage growth and real economic growth, you know, still in the 2, 3, even 4% range for a period of time. So I think this situation is different, and it speaks to the fact that corporations don't have a significant room to compress margins through paying higher wages. And I think that the ultimate strength and bargaining power of you know, the employment sector is weaker than we may be hearing from most people.
I think that you bring up a very interesting point, because I think, you know, right now, when it comes to the labor market, we're seeing, and you know, usually you can't make this distinction, but you can sort of make a distinction between a tight market and tight market versus sort of a strong labor market. And you know, I think the labor market is tight, but it's not really strong, considering that real wage growth has been negative for
a really good distinction, because if you look at something like the labor force participation rate or the employment to population ratio, they haven't increased at all in the last 7 or 8 months. And normally what you would see is, if real wages were so strong and an attractive option, theoretically it should pull people that are not in the labor force back into the labor force. It should increase labor force participation, and we're not seeing that at all. So for whatever reason, you know, these are sort of difficult concepts to pinpoint exactly. But despite the fact that nominal wages are going up a lot, real wages are still quite terrible. And that's not really causing a significant pull of people coming into the labor force. So I think that you make a really good point, in that the tightness that we're seeing is really just so many people that left the labor force, not really this, you know, massive competition to bid up wages.
Yeah, exactly. And so you're saying that the tightness in the labor supply is caused by people who've sort of dropped out of the labor force.
Right. Whether it's some combination of the boomers retiring or retiring early. And there seems to be a reasonable amount of evidence that COVID disabilities have contributed to something like maybe 1 or 2 million people dropping out of the labor force.
Okay, got it. Wow, that's that I hadn't heard of that.
Yeah, it's. I think the Brookings Institute did a paper on this, and it was either some combination of COVID disabilities or people caring for other people that now have COVID disabilities or something related to that. The reason why so many people have left the labor force is, I don't think totally proven yet, but in my opinion, it's some combination of some uptick in disability as a result of COVID and some combination of early retirement from boomers, some combination thereof.
Yep, got it. One more thing that's very interesting with regards to the labor market, and I've seen a bunch of people highlight this, is sort of the differences between the household survey versus the establishment survey. So, could you sort of jump into that, talk about some of the differences there and why we are seeing some sort of differential between the two?
Yeah. So it's a very, very significant difference that's going on. And I'll tell you about the differences and how I sort of rectify that. So the establishment survey is what most people follow. The establishment survey is the number that, when you turn on CNBC and they're all sort of guessing the number, that's the establishment survey. And that survey is surveys businesses, and it's also got this birth-death model associated with it. And, for whatever reason, that's the number that most people follow. It's a little bit smoother. It's not quite as volatile. So for those reasons, people tend to focus on the establishment survey. The establishment survey is showing labor market growth of about 2.5% right now, which is above the longer term average. Over the last 10 years, labor market growth from the establishment survey has been about 1.4 to 1.8%. And it's currently 2.5%. So that's where some people are deriving this tight labor market thesis from. Labor market growth from the establishment survey is above trend. One fact about the establishment survey is that it counts multiple job holders per job. So the example that I give is, if you drive for Uber, Lyft, and DoorDash, that's technically 3 jobs. Now, that's maybe a bad example because, as one of your last guests, Jim Chanos, points out all the time, they're independent contractors, they're not employees. But the concept is that if you have multiple jobs, that's counted as multiple payrolls, even though you're one person. Yep. The household survey counts one person for one person, irrespective of if they have 1 job or 10 jobs. So what we've seen over the past basically 6 months is this really massive gap between the establishment survey and the household survey, which either tells us that multiple job holders are increasing and the establishment survey is picking that up and the household survey is not, or the birth-death model, sort of the estimation factor, is a little bit off. The household survey, the trailing growth rate is only 0.8%. So if you look at the household survey, the employment market has lost jobs over the last several months, and it's growing below trend. So that's not very strong, right? So how do we rectify this? Which survey do we use? You see these people that don't have much of a process. They sort of pick which indicators fit their narrative at any given moment. To avoid that, what I do is I create, the same way I created a coincident indicator of the broad economy, I create a coincident indicator of employment. So what I do is I take several reliable metrics of the labor market from different surveys, different reports, different agencies, and I combine them all into one, all of them which have to have a proven track record, a long history. So you think about the household survey, the establishment survey, you think about aggregate hours worked, you got to include hours in there as well. And then when you look at the initial jobless claims report, they also provide an unemployment rate from that initial jobless claim. So you can look at the unemployment rate from a totally different survey. Mm-hmm. What you do is I combine all of those into one index, And then I track the growth rate of that index, because that says, hey, look, I'm not focusing just on the establishment, just on the household. It all goes into the hopper. It all goes into the index. And then I'm tracking the growth rate of the collective. And when you do that, what's really interesting is that that coincident index of employment that I have has contracted in 4 of the last 6 months. And the growth rate, the trending growth rate, has now fallen below trend. So I take an objective reading on the situation and I say the tight labor market story was a story of yesterday, because the most recently available data, when you aggregate it, is now showing that employment growth is below trend. So that's the way that I sort of square the differences in the two reports, is I put them all together and then I track the aggregate. Because, you know, when you have a process that's relying on various indicators, you can have an indicator that's 85 or 90% successful over time, which is a very good success rate. There's no indicator that you can follow that has a 100% success rate. Every individual indicator is subject to fail at random. But when you track a basket of reliable indicators, all of which have 80 or 90% success rates, it's much less likely that the whole collective basket is going to fail. So that's why I do it that way.
Gotcha. And I think that's very smart. We're sort of putting, bundling them together and then tracking the basket as an aggregate, as opposed to tracking individual indicators. And so, just within that, so, when it comes to figuring out whether an indicator is reliable or not, so is that primarily based off of sort of historical reliability? So has this indicator been able to say pinpoint turning, like been able to point out where the economy is going to turn, or where the employment is going to turn, etc.? Or do you have other metrics for looking at or assessing the reliability of an indicator?
Yeah, it's a great question. So I look at several things when I either incorporate a new metric into the bucket, which takes a fair amount of scrutiny. So basically, what you have to look for is, first and foremost, is before you study the indicator itself, you have to understand where that indicator conceptually fits into the economic sequence. So it's, if you're going to look at an indicator of employment, you have to understand where that employment metric falls into the economic sequence. Because one thing about business cycles is there's, nuances and idiosyncrasies from cycle to cycle, but they still follow a very predictable sequence in terms of things that happen first, second, third, and fourth. So it has to logically make sense, and you have to understand where it falls in the economic sequence. If you're looking, at an employment metric and you're trying to judge whether that's a leading indicator or not, you're never going to have any success with it, because it's just the wrong sequencing. So it has to be logical. That's number one. Number two is it does have to have a long history of reliably doing what you want it to do. So if it's a coincident indicator, it's got to reliably, coincide with the tops and bottoms of the economic cycle. If it's a leading indicator, it has to have a long history. And you want to judge how many false signals were there? How many times did it make an error? And you want to have indicators that have obviously very high success rates, very few false signals. The other things that you want to look at is you want to look at the volatility of the index, because, if you have an index that's extremely volatile, looking back 12 months, maybe you may see an inflection point, but it's so volatile in real time that it's difficult to discern, near-term economic events from that. So you want to look at the volatility. And then the last thing you want to look at is the magnitude of the historical revisions. So if you have an index that's really reliable, but it's only reliable after the second revision, then you may not want to include that, because we could be sitting here, in December, we're reporting data for November, but that indicator is not accurate until maybe February, right? Once it gets revised a couple times. So the gold standard is to have an index that's consistent across a long period of time, preferably many decades, so you have multiple regimes of inflation, deflation, monetary tightening, monetary easing. You want to have an indicator that's not extraordinarily volatile, and you want to have an indicator that has a relatively low revisions, or the delta of the final number relative to what's actually released. And that's sort of the process that I go through when I'm determining indicators and how they may fit into different buckets.
Yep, I think that's sort of like a great checklist or a set of points to note when it comes to looking at and assessing economic indicators by themselves. And so that question comes up. So one of the things that you mentioned towards the end was so a lot of these indicators, especially the big ones, say GDP or employment, etc., are actually subject to these big data revisions. And so what's sort of your view on data revisions, and how likely are they to sort of skew your real-time view of where we are in the business cycle?
Mm-hmm. Yeah. So with these government reports, they tend to be very accurate over time, but they can be subject to large revisions. So there are two types of revisions that most economic or government data goes through. We have the sort of first and second revisions. You look about the employment numbers. The number we just got will be revised twice in the next two reports. But then we also have these benchmark revisions, which are conducted usually on an annual basis or a 5-year basis. Those benchmark revisions can be quite large, and they make the data very, very accurate, but they're sort of so far in the future that those don't tend to have as much of a influence over economic decisions, because we may not get a benchmark revision for GDP for 6 more months, something like that. But when you're looking at the direction of revisions, tend to occur in the direction of the economic momentum. So when the economy is decelerating, future revisions tend to be in the negative direction. And when economic momentum is heading higher, then the revisions tend to be in the positive direction. Now, the really critical point is, what are the revisions around the inflection points? Because the economy may be accelerating and then decelerate. What are the revisions going to be when the economy kind of experiences that change in momentum? And those can be extremely tricky, because a lot of this economic data is estimated, and they have sort of these linear econometric models that spit out the numbers, which make them have heavy revisions around the inflection points. Because when the economy is trending higher, the estimation models are extrapolating that forward. And then only when we get the revisions, many months later, and it becomes more accurate, do we realize that, oh, there actually was an inflection point. And the way that we handle that is by studying those earlier sequences. So if you have a downturn in your longer leading indicators, you have a downturn in your shorter leading indicators, and those longer leading indicators look recessionary, shorter leading indicators look recessionary, and then you get an employment number, my bias would be that the employment revisions would be towards the downside. Because we have good evidence that when the labor market does inflect, it happened in accordance with sort of the historical economic sequence. So revisions of the economic data tend to happen in the momentum of the economy, which means that I expect the economic data around this time period, October, November, December, sort of the stuff that's coming in now, I expect in the future, when we look back at this period, we're going to see economic and coincident indicators that are lower than what we're seeing reported now.
Yep. No, that makes sense. And one more thing. So when it comes to leading indicators, so one of the things that sort of, I guess, everyone loves to watch and talk about is this yield curve, and how the yield curve is how a lot of the yield curve has been inverted over the last 6 to 12 months. And so so where that's interesting is typically people look at yield curve and say, okay, yield curve is inverted, therefore we're going to see some sort of a recession within, say, the next 12 to 18 months. So what is sort of your view on the yield curve, and how do you interpret the yield curve? And then on top of that, what's sort of your view on QE, QT, considering that we sort of have more data now, since the start of the Fed hiking cycle?
So as far as the leading indicators are concerned and how the yield curve plays into that, that would be in the longer leading bucket. Because as you mentioned, when the yield curve inverts, historically, that signals a recession on average 12 months later. Now, sometimes the lead time is shorter. We've seen like 6 months before. Sometimes it's longer. We've seen like 20 months, right? So all these leading indicators have a range in terms of their historical track record. The yield curve tends to have quite a large range, but on average, it's about 12 months from the initial inversion to the start of the recession. So the yield curve defined by the most popular 2s10 spread inverted in June of 2022. So you say, okay, does that make sense? Well, we have a tightening of monetary policy, we have a downturn in the housing market, and we have an inversion of the yield curve. So that's a good, a reliable basket that signals monetary restraint. And if we extrapolate the average, which is 12 months, that would imply a recession landing somewhere in the vicinity of, June of next year. Sort of that 6-month window that I talked about is historically consistent. So the yield curve is a very reliable indicator, in my opinion, specifically when it's combined with a basket of other indicators in that sequence, and then confirmed by shorter leading indicators, which we're seeing now, like a decline in new orders, decline in trucking and transportation. So yield curve, in my opinion, very good, reliable signal of recessionary probabilities. The fact that we're seeing an inversion, or we've seen an inversion, is very consistent, and I think supportive of the idea that a recession is certainly in the forecast. Can you remind me what the second question was in that?
The second part of the question was sort of talking about QE, QT, your views.
Oh, yes.
Considering we have more data since.
Yeah. So I'm of the opinion, which I think is counterintuitive and counter to mainstream, that quantitative tightening flattens the yield curve and quantitative easing steepens the yield curve. Now, to most people, that doesn't make a lot of sense, because if the Fed is buying bonds, people believe that suppresses longer-term interest rates, and that should lead to a flattening of the yield curve. And when the Fed is selling bonds, that should lead to a steepening of the yield curve, because there's no one there to buy them. It's never actually worked that way in the several episodes of quantitative tightening that we've had. I mean, we see today, when the Fed was gearing up to do massive amounts of quantitative tightening and Treasury issuance was increasing, we had many people calling for this great steepening that we were going to see, because no one was going to be there to buy 10-year and 30-year bonds once the Fed stopped, the banks stopped, and everybody stopped. But what have we seen? We've seen a yield curve that's actually more inverted than any time in history, right? So how does that happen? And the reason that happens, in my view, is because of a quote that I take from Henry Hazlitt, who wrote a book called Economics in One Lesson, which is that you can't look at the immediate effect of any policy. You have to look at how that policy is going to affect the entire economic sequence and all participants, all players. So the reason I believe that quantitative tightening always flattens the yield curve is because when the Fed is doing quantitative tightening, that's a contractionary monetary activity. That tends to widen the risk premium of interest rates relative to Treasury rates. So mortgage rates, let's say. So the spread between mortgage rates and Treasury rates starts to widen. That puts downward pressure on the housing market. That then slows the rest of the economy. And then the yield curve responds to the slowdown in economic growth and increased recessionary probabilities rather than this supply narrative. The bond market never reacts to these supply narratives. So quantitative tightening, to me, is always a flattener, because it slows economic activity, by basically pushing more duration into the economy, widening out the spread between private rates and public rates, putting downward pressure on the economy, increasing recessionary risk, which the yield curve reflects through an inversion.
Yeah, I think to add to that, so one more thing that we see typically within not directly within QT policy, but usually QT is complemented by the Fed hiking, and so when the Fed hikes, that drives the yields on the short
Exactly.
end of the yield curve higher, which I think is also
Definitely.
worth mentioning.
Totally.
Yep.
Totally.
And so, from sort of an asset allocator standpoint, so when it comes to building an asset allocation at this point in time, so what asset classes would you be looking to when it comes to actually investing money? So one of the sort of quote unquote classics would be, so as we see inflation slow down and as we see the economy slow down, sort of the obvious trades ends up being buying, say, the 10-year, the 30-year treasury. So is it that simple? What else are you looking at, and where are you looking?
So I don't run any outside money, and there are an infinite number of permutations on how you can wrap an investment strategy around economic cycles. I tend to just put forward the most simplistic way to use economic cycles, which is that when the economy is accelerating and growth is increasing, that's a time that you want to take on as much risk as possible. That generally would mean more speculative risk assets like stocks and credit and things like that. And when the economy is slowing down and heading towards a recession, that's the best time to be as defensive as possible. And I phrase it in those terms because everybody is completely different, right? Somebody listening to this could be a long short manager. You could be a multi-asset manager. You could be just a fixed income manager. So when the economy is accelerating, you want to take on risk. When the economy is decelerating and recession is a likely outcome, you want to be as defensive as your investment mandate allows. That's where I believe that we are now. So I would be advocating for a significantly defensive investment posture. Now, to put that maybe in a more concrete asset allocation, one of the things that I do personally is I always approach the world with a balanced portfolio, something like the all-weather portfolio, right? It's got stocks, intermediate term bonds, long-term bonds, gold, and commodities. And based on the environment that I see coming over the next couple of quarters, I'll simply tilt my asset allocation in the direction of the assets that are likely to perform relatively better and avoid the ones that are likely to perform relatively worse off. So at the moment, given that asset all-weather sort of framework, I'd be more tilted in the direction of treasury bonds and gold. I'd be less exposed to the riskier sides of that portfolio, which would be stocks and your industrial commodities like copper and oil and things like that.
Why gold though? So that's sort of an interesting thing you bring up, because I think what's interesting is historically, sort of gold has not really, since the end of the 1990s, gold hasn't really kept up with inflation. And it sort of has a function as a safe haven, but otherwise, it's not really been sort of the asset that, or it's not really been something that's really performed over, say, the last 20 years. So why gold?
Yeah, it's an excellent point. The real return on gold tends to converge to something like 0 or 0.5%. So it's definitely not going to add a ton of return to your portfolio. But what it tends to be is it tends to be uncorrelated to some of the other assets. So it provides some stability to the portfolio basket. And then the other thing is that it's a relative bet. It's a relative trade. So when the economy is accelerating, I would reduce my allocation to gold very, very, very low because, like you said, it doesn't really add a whole lot of value, right? It's not going to really provide a whole bunch of return. I'd much rather be in stocks and maybe some of your more speculative industrial commodities. But when the economy is slowing down, it's not that I think that gold is going to perform really well. It just tends to be an asset that holds up better than your risk assets. So you may plot something like the ratio of stocks to gold. You look at like maybe the Russell 2000 to gold. It tends to track the economic cycle quite well. So, the environment that we're heading into, which may likely be a more disinflationary or deflationary type recession, that could definitely be a negative for gold in absolute terms.
Yep.
But it should still hold up better than the more speculative risk assets like stocks. In other words, I would expect the ratio of stocks to gold to fall in a recessionary environment. So I would preference treasury bonds first for the environment that I expect to come. if I had to rank them, then gold, then stocks, then commodities. So it's more of a relative bet, because I totally agree with you that over time, it tends to provide stability, but not much else than that.
Got it. Yeah, no, yeah, I agree. So gold has that sort of orthogonal payoff in the sense that it doesn't really move around, I guess, with the typical quote unquote beta. And one more thing. So when it comes to recessions, do you have a way for classifying recessions in the sense that a recession with negative, I guess a quote unquote recession with -1% GDP growth versus something with say -5% versus say something like the Great Recession or even say the Great Depression. So those are like monumentally different events, and
Right.
they have completely different implications for the economy and for society as a whole. So within that, do you have ways for classifying recessions? And how deep do you think the sort of upcoming recession is going to be?
Okay, so a couple things. So as I mentioned, that coincident indicator bucket, you have income, consumption, production, and employment.
Yep.
Generally, they track in the same direction. So a recession is defined by when that collective basket is below zero, right? So if you take those four indicators, you combine them together like I do, and that goes negative on a growth rate terms, let's say year over year, that's a technical definition of a recession. Now, in terms of judging, one recession versus the other, you may look at obviously how negative it goes. So is it -1 or -5, as you say? But then it's also worth looking at the subcomponents to say, are, one of four indicators negative and it dragging the whole basket down? Are two of four negative? Are all four negative? That is what sort of gets you to more severe recessions versus more mild recessions. Maybe, in a very mild recession, you have a contraction in employment, income, production, but maybe, your broad basket of services consumption really doesn't fall. Maybe it falls a fraction of a percent or something like that. So I think that the way that I judge the severity is, one, based on how negative does the growth rate go, -1 or -5 or -10, and then how widespread is the negativity across all of the subcomponents of the basket that I'm tracking, and then the relative magnitudes between them. In terms of how severe the recession may be going forward, I don't comment on that in very concrete terms, because these leading indicators and this cyclical process is much more reliable in determining the direction of growth. It only secondarily may give you impacts on the magnitude. So it's I have to basically caveat by saying that my estimation on magnitude is more speculation, where my view on direction is more data driven. My hunch is that the recession may be more severe. And the way that I'm arriving at that conclusion is because when you go back over time and you look at the more mild recessions, the most recent one being 2000, 2001, it wasn't mild for asset markets, but it was mild for the economy. It was barely a contraction. And the more mild recessions tend to be correlated to very minor slowdowns in the housing market. So the 2000s recession barely came with any slowdown in the housing market at all. Home prices actually never really fell at all. And the volume of housing activity based on a composite of different metrics only fell something like 5 or 10%. Compared to today, where the volume of transactions has fallen 35%. So again, it's definitely more speculative, so take it with that caveat. But when you see significant downturns in the housing market, in my estimation, that tends to correlate generally to more severe recessions because of that multiplier effect that we talked about earlier. So if we didn't have a big slowdown in the housing market, I may be more sympathetic to the mild recessionary calls, but it seems increasingly unlikely to me that as the volume of transactions in the housing market goes down 30, 40, and maybe in the future 50, 55%, that we can avoid a more substantial recession.
Yep, makes sense. And so right now, so in a way, the probabilities of a deeper recession, just in probabilistic terms, so you'd say they are higher.
I'd have to lean in that direction. Yeah, I'd have to lean in that direction.
Gotcha. And what and sort of to wrap it up, if we or sort of once we see some sort of recession next year, what's going to be what's going to be the way we sort of get out of it? Is it going to be the conventional ways of where central banks start to cut rates, pump in liquidity, and then the government intervenes with some amount of fiscal policy? That's been the typical response for ever so long right now. Or is there is there something else going to change?
Well, tough to say. I would lean towards the normal response is probably going to be something along the lines of what we get here. It may be more delayed than normal, which also could be another factor that tilts the scales towards more severe, given the fact that policymakers perhaps will be more reluctant to come to the rescue until they see inflation come down closer to their 2% target, which is unlikely to occur until at least Q1 or Q2 of 23.
Mm-hmm.
So to the extent that the economy falls into recession, perhaps Q1, maybe early Q2, and the Fed is not, responding with, cat-like reflexes, to the extent that they're a little bit more delayed, that maybe will tilt the scales towards more severe. But when they do eventually decide to respond, I would expect the traditional response of, slamming interest rates down, ending quantitative tightening, and likely some fiscal response coming from the federal government. Things that I would be looking for the economic cycle to be moving in the other direction would just be the opposite of the sequence that we outlined. So I'd be looking for that, rate of change easing in monetary policy, looking for a steepening of the yield curve. I'd be looking for a stabilization and a rebound in some of the earlier housing metrics.
Mm-hmm.
That would be signs to me that the economy in the future is going to rebound and probably come out of recession.
Got it. Awesome. With that, Eric, thank you so much for an awesome podcast. It was great talking to you, and I think our listeners are going to have a lot to learn. I've certainly learned a lot, so I think our listeners are going to have a lot to learn as well from you. So, thank you so much for coming on.
Yeah, thank you so much. It was good talking to you. I loved your questions, and it was nice to meet you as well.
Yeah, fantastic.